Toronto condo market is showing a double dip decline for the first time on record. So this is a piece of news that all of us should be paying at least some attention to, and this is the first topic of a conversation in this video. Since our main focus on the channel is Toronto and the GTA, then I'm going to switch gears and talk about the local market, i.e. what's happening within the condo segment in Toronto and the Greater Toronto area. And then we're going to shift gears again and talk about some predictions for the fall, because we're just a week away from the next announcement by the Bank of Canada. We are all eagerly anticipating as to what they're going to say about the rates. Are they going to cut the rates by 25 basis points, or is it going to be 50? So we'll talk about that, and we'll see how we believe the fall market is going to unfold. Canadian condo prices see first double dip decline on record. Over the past 10 years, pre-construction condos have been a source of great joy and revenue for investors that decided to put their money into real estate. But as of late, it's a reason for concern, and it feels like it's a liability more than anything else. Canada's condo market has provided big returns for investors, but it's currently running on fumes. Canadian Real Estate Association data shows the price of a benchmark or typical condo apartment fell in July. The investor-dominated segment didn't see prices fall nearly as much as the general market since rates began climbing. However, condos have resumed a downturn after a short break, as rate cuts failed to bring a surge of buyers that many had anticipated. Yes, that was a narrative that we were hearing from everywhere, that once the rates are cut, and we had 2 rate cuts by this time, the buyer activity will increase dramatically, prices will start climbing up again, but none of that had happened. If you look back from where we are right now, which is the end of August, the performance over the first 2 months of summer was completely disappointing. This is the double dip decline that we're talking about here. It's not as well pronounced in this particular graph. You see that the market went down, so it's forming a W. In 23, then it went up for less than a year, and then again went on a downward trajectory. We're going to see this with more clarity on another graph, which I'm going to show you in just a minute. Soft demand for condo apartments is wearing down prices, but they remain lofty. The price of a benchmark condo apartment fell 0.5% to $526,500 in July. Prices are now 3.2% lower than the same month last year. It's a substantial discount, and the market momentum is heading in the wrong direction. Yes, it's still heading down, and we can see what's happening on this graph here. So that's the letter W that we're talking about when we discuss the double dip decline in the condo prices. March 2023, we reached the bottom, then the prices went up for less than a year, and in September of 23, the market started trading sideways, a slight dip here, and then again, come March of 24, condo prices started declining at a pretty rapid pace, and the rate cuts thus far have not produced the results that people were anticipating. Looking at just the 12-month change in price understates how much they've pulled back. The benchmark price is 9.6% lower than the record high reached in April of 22, significantly more than people may assume from just the annual growth rate, but not even enough to be considered a correction. If the market warrants a correction, this double dip might be where it starts. Completely can be the case, but before we discuss whether this is the beginning of a correction or a major market crash, let's just talk about what's happening in Toronto specifically, because this market, by and large, is an indication and a driving force behind of what's happening in the rest of the country. Switching gears to talk about what's happening in Toronto, and I want to start with the number of insolvencies that big developers have been suffering this year as compared to the past couple of years. The total number of projects that went into receivership this year is at roughly 200. The total number of projects in the GTA that are underway is roughly 2,000. So 10% of the overall number of projects that are under development is going into a receivership. The increase in insolvencies between 2022 and 23 was about 44%, and then that number went closer to 50% for 24, and it's still rising. The question that I would want to ask you guys is, I want to see your opinion in the comments section below as to what is the threshold beyond which the development community is going to start folding like dominoes, like what we had in the 80s, and are we on a verge of that occurring? One thing to keep in mind, of course, and we're going to come back to this conversation, is that the interest rates are actually going to be declining, most likely with the highest level of probability over the next year or so. So let me just take you through the phases of a typical construction project and how that goes. Developers have to sell about 70% of the total number of units that they're planning to build before shovels hit the ground in order for them to obtain financing from their banks. And then the project will be underway, the construction crews will start arriving on site, and the building will start coming up. The process of getting all the approvals and erecting a building takes anywhere from 2 to 4 years, depending on the location and how forthcoming the municipality that you've made the applications with is going to be with you, and on how easy or difficult it is for you to pre-sell and get financing from your banks. So for projects that started back in 2019 and 22, they started at price points of that time, forecasting the price increases normal for the marketplace over the next 3 to 4 years. But then things have changed with the pandemic, and prices, say, for materials have gone up on average by 50%. So things like steel, lumber, concrete have all gone up by approximately, if you average that out, 50% over the intervening 4 years. The cost of labor has gone up by roughly 30% between 2019 and 2024. There was shortage of skilled labor, and developers and builders had to bid the prices up in order to attract skilled workers on their sites. So 30% increase there. The government fees have gone up by approximately 50% as well. A cost of the typical approvals required to build a single unit within a building back in 2019, 2020 were at a level of roughly $40,000 per unit. Right now, it's at roughly a level of $60,000 per unit. So that has gone up by 50% as well. Remember that 70% of the inventory that the developers had was already pre-sold back when the project started. Now, developers are sitting on the remaining 30% that they have to sell, knowing that their costs in the past 3 to 4 years have increased by roughly 40 to 50%. So they either need to try and bring the project to completion with the original projected profitability, or at the very least, and I think that this is a more likely scenario, nowadays they have to try and break even. So in order for them to do that, the most straightforward way is to try to sell the remaining units at prices that are 40 to 50% higher than what people had paid for the same units back when the project was starting. The consumers, of course, looking at this are saying, well, you know, with the interest rates where they are, we're not really interested in paying those types of prices with the current interest rates for the units that developers have remaining. These are not liquid at this point. And that's kind of a good case scenario, because a lot of the developers are building 1 out of 4 towers, and then they call it quits because they cannot continue, given the rising prices between the year when the project was started and the time of completion of that first phase of a 4-tower project. So and then they're pulling out, and then they go into receivership. So everybody's between a rock and a hard place within the development community. And I'm hoping this is not going to be a repeat of what we had back in 1980s, where the developers were going into receivership en masse. I would love to see your comment on whether we are at that breaking point. So that's kind of a starting point of a potential problem within the marketplace. It starts with something, and this something could very well be the developers going into insolvency right now at an ever-increasing number. So that puts tremendous price pressure, not only on new construction projects and the units that remained unsold, but also on resale condos just as well, because there's always a price comparison and a quantifiable difference between one and the other. So that brings us to the next point of what's going to happen with the interest rates and the market. And there's a couple of ways of looking at that. So one is that most of the analysts and economists are in agreement that the interest rates are going to be in a continual decline between now and at least the mid 2025 period. So we might have a 1/4 point decrease during every announcement between now and the end of the year, and then it will continue for the first 6 months of 25, bringing us to, say, around 3% mark for the interest rates. But things could go a bit faster. And the reasons for that are this. First of all, the CPI had fallen almost to a level that the Bank of Canada was declaring as the target, which is 2% for the inflation. And if it continues falling, with the bank acting slower than they should in decreasing the rates, then we might go into a negative inflation territory, which is bad ultimately for the government, because the repayment of debt will get more expensive. So that's a very simple explanation for that. The Bank of Canada does not want to let that happen. So that's one set of considerations. The second set of considerations is that the economy might go into a deep recession if they do not act fast enough. The developers can start defaulting en masse, and the consumers will stop their activity completely. Like, they will not be closing on new construction projects that they've bought. They will not be buying anything on the resale market, or the level of activity will decrease. And the fall market and the spring market of 2025 are going to be reflecting a massive market correction. So that's another consideration for the central bank to consider as well. So it could be that the interest rate decreases will be more rapid than just 25 basis points during every announcement, and I wouldn't be completely surprised to see a 50 basis point decrease in the policy rate during the announcement in September. So I also would like to see your comments on this topic in the comment section below. And there's another question that is probably looming on everybody's mind, and that is, are we on the verge of a massive market correction or a market crash when it comes to real estate? And things start normally from big metropolitan centers. So it's quite probable that if anything is to start resembling a severe market correction and a downturn or a market crash, it will start in Toronto or the GTA. There are several examples of big market corrections in the past 3 or 4 decades that have all the hallmarks of what we're seeing right now in Toronto. One such market correction or market crash was in Japan in 1980s. Low interest rates for extended periods of time, rampant speculation, construction boom, investor-dominated market, and then the rates go up, the market crashes. A market crash in Spain, the same pattern. Investors are buying all the inventory, construction boom, low interest rates. Market crash in 2008, starting in the United States, global financial crisis, the market crashes. The market crash in Ireland in the 2000s, exactly the same pattern. Low interest rates, construction boom, investor-dominated market, rampant speculation, 2008 financial crisis, the market crashes. So we're seeing very similar set of patterns playing out in those market crashes, and it's entirely possible that something that will act as a trigger in Canada, some negative economic event, geopolitical catastrophe of some sort, negativity coming from the United States that will impact our Canadian economy, and it could very well be very soon with the looming elections in November in the US that things will change there in some significant fashion. There'll be some seismic shift in policy or the economy in the US, and that will impact the Canadian market. That could precipitate a market crash in Canada as well. So I would like to see your comments in the comment section below on whether you think that we are on the verge of a massive market correction or a market crash in Canada. So I'm going to wrap up this video, guys, on this note. If you are in a fortunate position when you're sitting on a pile of cash and you do believe that the market is going to continue unaffected for the next 6 to 12 months, there is plenty of opportunities for you to consider, especially when it comes to condo space. There's plenty of people that are over leveraged and they're looking to sell off their units, often at a massive loss. So one person's loss is another person's gain. In this case, this is unfortunately a zero-sum game. If you end up being on the other side of the fence and you are in an unfortunate position where you are over leveraged and you have to sell, I suggest that you talk to us. I will include a link to our calendars in the description below. You can either talk to me, my name is Vlad, or my partner Mitra, and we'll give you a 15-minute free phone consultation. We'll talk about how you can extract the most equity out of the property that you have. We'll talk about timing. We'll talk about location. We'll talk about your specific objectives with respect to this property as well. And I'm looking forward to actually some positive news in the coming weeks. We'll see what the September announcement is going to bring. I'm hoping that this is going to be a higher interest rate cut than just 25 basis points, and that could revitalize the market very quickly. We'll see what's going to happen. I'm looking forward to talking to you again next week.